Hi everyone, I'm Jaron with Centered Financial. Just wanted to share a quick video with you for our monthly investment update for July 2024. So through the first part of 2024, the stories continue to be the AI trade. The large cap outperformance has really come from US technology companies, and really it's come from the Magnificent Seven, the top 7 companies of the S&P 500. However, it may be time for a change. So far in the past week, we've seen a little bit of a rotation with a sell-off in technology and a broadening of performance, which has actually spread to even small cap companies. As you can see again on this slide from BlackRock, large cap stocks have had the greatest outperformance over small caps that we've seen since 1999, with large cap up to over 15% year to date and small cap just giving us about a 2% return so far. However, in the last week, we saw small caps bump with about a 5% return in one day, and they've continued over this last week. How long that lasts and how long we see this broadening, it's always tough to guess, but that's a little bit about what's been going on so far in the markets. This last week, we also saw some action in the markets from political headlines. So with some volatility in politics, we saw a return to the so-called Trump trade. What that means is that with an expectation for Trump in the presidency, that brings expectations of further government deficits. With tax cuts and increased government spending, that means that we had a bump in intermediate treasury yields. And then also the rotation with the sell-off in tech to more cyclical industries like energy and financials, industries that would benefit from deregulation. So we saw a little bit of that last week. We also saw a bump in crypto with a Republican platform coming out very pro-cryptocurrency and anti-regulation of the crypto markets. There's also some of President Biden's comments contributed to the sell-off in trade, him being tougher on China. Really, the expectations with increased tariffs of a Trump presidency, we'd expect some decrease in corporate profits, especially among large tech. So that being said, please keep in mind that most of these moves have been very reactionary and not based on fundamentals. And we never want to base our investment decisions on short-term emotional bets. At Centered Financial, we always teach to stay centered with your investments. Maintaining a long-term balanced portfolio, we feel, is always providing a better opportunity to reach your long-term financial goals. So just to reinforce that, I want to show you some data that we pulled from BlackRock's mid-year market outlook. As you can see on these slides, the market really doesn't care who's in the presidency. Stocks have continued high regardless of which party is in the presidency. And especially, we see some surprises. So, the second slide shows that over the last 10 years, you would have been kind of equal in your investment returns, depending on if you invested only when there was a Republican or a Democrat. But if you invest in the entire time, you're going to make a lot more money. Over the last 70 years, same thing. But what's interesting to me is if you look at the US stock sector performance by president, especially over the last two, it's kind of surprising, that energy has by far been the best performer under Biden's presidency, which we normally wouldn't expect with a Democratic president that runs on the agenda of being very regulatory, especially to industries like energy. But energy's done very well. On the flip side of that, energy was the worst performer under a Trump presidency, which again, we would expect under Trump being very friendly to oil and energy industries. So this just drives the point home that it's important to be diversified. It's important not to make bets on what you think the outcome would be under a certain president. And that's why we typically don't make our investment decisions based on who holds the office. Now I'd like to just switch gears and talk a little bit about the economy. The second question that we always like to answer in these updates is what's up with the economy. What we've seen so far this half is the economy has actually been doing pretty well. We've been in this expansionary environment. We've avoided that long expected recession. And even with tight monetary conditions, with very high interest rates, very high inflation, the economy has continued to grow. We're starting to see some cracks, and now it may be time for the government, for the Fed to ease off their policy, which part of that is looking at the consumer. So we've seen some behavioral conditions in the consumer, especially among the lower income cohort. As you can see on this slide from BlackRock's mid-year market outlook, where we've seen just a little bit of a pullback in spending, increase in delinquencies. So that's definitely a red flag that we start to see behavioral conditions of the consumer start to tighten up. Second thing that we're seeing is leading services indicators have moved into contraction. Coming out of the pandemic, where all the services were shut down, we saw this big explosion in travel and restaurants and all that, and that's continued to move over the last few years, and we're starting to see that ease back now. Again, that's a sign of a tighter economic environment, and manufacturing has kind of maintained in that tight environment. So all of those have been leading to that we're starting to see the Fed's work with interest rates start to work. The other thing that we started to see is a tick up in unemployment. So all of that leads to expectations that the Fed will start to ease now. We'll probably see at least one, probably two rate cuts in 2024, and the probability of that is increasing. So what that means, rate cuts mean easier financial conditions. Definitely with rates coming down, that increases lending, which typically reflects good on stocks because that's a boon to corporate profits. But also on the personal side, that makes it easier for us to get a loan. The downside is cash rates that we've enjoyed. These high cash yields may start to come down a little bit. So again, that just reiterates the importance of being diversified in our portfolio, having those intermediate term bonds in our portfolio, pushing out the duration so we can get yields beyond just what we've been getting in cash over the last year. So that's it for our monthly investment update. We hope you enjoyed it. Hopefully that was helpful. As always, if you have questions, specific questions about your investments, we'd love to hear them. So please reach out to us, and we look forward to speaking with you. All right, take care.